I think gold is going to be much, much higher over the years. And the reason why I say that is because the United States only has it's an insolvent nation. If you look at our total liabilities, totally unfunded liabilities minus our assets minus total unfunded liabilities, it's negative. So that's not my opinion. That's, you go look at the debt clock and you'll see I'm correct.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have an awesome discussion lined up. We're fortunate to have with us Michael Pento, founder of Pento Portfolio Strategies. He has more than 30 years of professional investment experience. Michael, welcome back to Metals and Miners. Thanks so much for joining us today.
Wow, 30 years. I think it's closer to 35 now.
Oh, my bad.
Time keeps marching on.
Well, I don't want to undercut you, so.
Thanks for having me on, Gary.
Yeah, no problem. All right, so President Trump's economic strategy seems to hinge on two main goals. Domestically, drive investment into U.S. manufacturing and cut government spending, using tools like tax cuts, controlled government spending from DOGE and some other things, and then internationally strengthen the U.S. position against China, negotiating peace, strategic tariff use, and some other tools. So it seems that President Trump will likely favor a U.S. dollar that's weaker in the short term to stimulate manufacturing and exports. Your reaction?
Okay, so a lot there to unpack, as they say. Well, first of all, tariffs would normally lead to a stronger dollar, so I would take the other side on that. I mean, one of the ways China could combat our tariffs is to just ruin their currency, and they lower the value of their currency, and then all of a sudden, it's the same import price for the United States. So their prices would be lower. It takes less dollars to buy their goods, and then it would be the same price to the consumer. So that would lead to a stronger dollar. Of course, Donald Trump is on record, and I have to say I voted for the man twice. I think he's infinitely better than Kamala Harris would have ever possibly been. But so I always preclude that when I say, but I'm not saying that he's the second incarnation of either Ronald Reagan or any other Austrian economist. So right now, what we're looking at is tariffs and deportations, which in the long run, I believe could be very healthy for the U.S. economy. But in the short term, a decline in the labor force is half of GDP growth. So GDP growth is falling on a second derivative basis. And you add in deportations to that, and then you add tariffs into that. And you could see why the NASDAQ, for example, is down on the year. I mean, we're headed into the last part of the quarter, the last third of the quarter for this year, and the NASDAQ is down. And I think the S&P is pretty much unchanged now. It's up less than 1%. And there's a reason for that, because stock prices are priced to perfection. They're trading at like 24 times earnings growth of this year, which is supposed to grow by 14%. It's just not going to happen. GDP growth is running at around 2%. Say nominal growth maybe around 4.5%, 5%. You just can't get 14% earnings growth out of that number. So stocks are at record high valuations, and they have to come down, in my opinion. Now, I'm not saying they're going to crash, and there could be some room left on the upside, Gary. I'm not short the market right now. But I am saying that the upside is very limited. And eventually we're going to have this reconciliation of asset prices, and that includes real estate and equities. They're still massively overvalued vis-a-vis the economy or incomes or any other metric you look at it. And that imbalance has to be repaired.
So we're going to definitely jump into the markets, but I wanted to ask you a few questions on the economy first. So the U.S. economy's strength has been driven by several things, including upper income spending, which now accounts for nearly 50% of all consumer spending, which has been fueled by what you just talked about, the high stock market gains, the real estate gains, et cetera. So can the U.S. economy continue relying indefinitely on upper income spending as a primary driver of growth? Or is there, a historical precedent where a similar dynamic eventually led to economic instability or even a shift in consumer behavior?
So, as you accurately pointed out, and this is rare, where 50% of consumption is derived from the top 10%, not even the top quintile, the top 10% of consumers. And they've done fine. The $5 trillion that the Fed printed went mostly to boost asset prices, unfortunately. And that the bifurcation of the economy has never been greater. But the lower four quintiles are really hanging on by a thread. They've been destroyed by inflation. And people always say things like, oh, incomes are outpacing inflation. Well, tell that to the 7.5 million retirees who don't have any income. They don't have a job. What's their raise been? So we are clinging to asset bubbles. Asset bubbles require a constant stream of hot air, also known as money supply growth. And I see that attenuating. I see the reverse repo facility, which has come down from $2.5 trillion to just about $70 billion. We have the Treasury General Account, which has about $700 billion. That's a very unreliable metric to see when liquidity ebbs. But here's the thing: we have about 3.2 trillion in reserves in the system, which is historically that's off the charts. Before the global financial crisis, reserves were just a couple of dozen billion. So there's 3.2 trillion in reserves. But we know that the market went down over 20% in 22 when there was a decline of reserves from 3.8 trillion to around a little bit over 3 trillion. So I think the reserves in the system are slowly being drained. They get drained from two sources: the Fed's quantitative tightening program, and when reserves are created to currency, reserves, when there's a run on banks or people want cash, reserves go down. So those two things are happening. I think eventually that's going to cause some real problems in the liquidity that's been funneled into these asset bubbles. And then you're going to get the top 10% of consumers in a world of hurt. And then the recession comes, and then you could see a dramatic wipeout of equity values and real estate values. And it could happen very quickly. I have a model that models that. The model tells me right now there's nothing to worry about. This is what's happening now. As I mentioned, the first 2 months of the year, the market's going through a consolidation period. It's not time to panic. But when it is time to panic, my model will hopefully pick up on that, and we can get short this market and hopefully profit from its demise. But that doesn't sound. I hope that doesn't sound nefarious. The best thing that could happen, Gary, for this nation's long-term viability is to ensure that our children can afford to buy a house.
Absolutely.
And that retirees could retire, or people almost going to retirement, or people that are already retired don't have to panic about, what's my S&P 500 index done today, or my closet index fund done today, my target date fund is done today, because you're going to have a fair valuation. And I love this metric. It's Warren Buffett's favorite metric too. The total market cap of equities is 200, as of yesterday, was 206% of GDP. That is astronomically higher than where it should be. It should be closer to 100, right, or maybe even just below that. So, for the stability, viability, and peace of this country, we need a middle class that's thriving, and we don't need to worry about when our asset bubbles are going to collapse.
So you have an open invitation to come back on the show whenever your program determines that it's time to panic, and to let everybody know, hey, all the signals and warnings and bells are going off. Okay. All right. So
thank you, Gary.
Yeah. So Michael, another area of economic strength has been AI related investment, particularly in data centers. In the last few days, we're seeing Microsoft backing out of some large data center contracts. They're still proposing to spend many billions, as are the rest of the Mag 7. But since the DeepSeek AI drop a couple of weeks ago, things seem a little bit different than before that. So I don't know if that's the right word, but that's how it feels. Do you expect AI related investment to continue at these incredible levels of the last few years, or do you expect some kind of sea change? And if so, do you expect ripple effects throughout the economy?
So I liken it very closely to what happened in '99. Was Cisco a viable company? Were their switches and routers viably needed for the sustainability of the internet? Was the internet real? Absolutely so. Did that stop Cisco from dropping by like 80, 90%, or Amazon 80, 90%? No, it didn't stop it. There's a lot of overinvestment in the AI space right now. Companies were tripping over themselves to invest in these NVIDIA chips that may or may not be necessary, because we have the open source from DeepSeek. What I can tell you for sure, what I'm very, very confident in, is that when you have 7 stocks leading the index higher and everybody owns them because they're cap weighted and they're highly concentrated positions and they're the only things that are really working well, history is very clear that won't last. And it usually ends in disaster. So there'll be what I'm doing with my money, and I invest money for a living, and I'm investing in those other spaces that have been neglected. We own banks, we own low volatility investments, and we're eschewing growth for those orphaned indexes and orphaned companies that are really much better valuation than 50 times sales.
Yeah. Okay. All right. So staying on the economy, one last question here. Another pillar that's holding up the strength of the economy has been government spending at all levels. Infrastructure projects, CHIPS Act, social programs, waste and abuse, fraud, you name it, the whole thing is in there. But, fiscal dominance is the phrase with, incredibly high deficit spending. So now the Trump administration, they've offered buyout packages to all the government employees, and many have taken Trump up on that. Not a huge percentage, but many people have. Along with Doge, they're slashing agency spend and jobs. In DC, I'm sure you've seen this. They've seen a spike in real estate inventory and a plunge in values over there. Many believe it's directly tied to the Doge layoffs. Bottom line, government spending doesn't appear that it will be carrying the same weight that it has over the last several years moving forward. So with that in mind, do you expect that to be a problem for the economy?
Yes, 100%. As I alluded to before, one of the biggest growth engines of employment were government-related jobs. It was one of the leading sectors in job creation throughout the Biden administration. That is over. Not only are we not hiring them at the same rate, we're firing them. So that rate of change is dramatic. You're looking at a deceleration. Not only that, but you're looking at a negative complex there. So I would expect the initial claims to spike, and not only in the federal government, but even state government jobs too. So they go hand in hand together, because state government jobs support federal government jobs.
And to your point, I don't mean to interrupt, but to your point, Ron DeSantis, the governor down of Florida, just came out that he wants to establish a statewide Doge type agency for the state of Florida now. So there may be other copycats in other states following now this as well.
Yeah. So as I stated before, labor force. So there's 2 parts to GDP growth. There's productivity and there's labor force growth. Those are the 2 inputs to GDP when it comes down to it. I'm not talking about the GDP formula. I'm talking about the 2 components that go into GDP. So you have half of them offline right now, half of that offline. So I expect initial claims to spike, and I think that could affect not only stock prices, it could affect the real estate market too, because what you had from Wall Street was, hey, this is my model. I'm gonna borrow money at 2 or 3%, buy huge tracts of single family homes, and then I'm going to rent them out. So I'm generating income as my asset price goes up. The asset price, if you look at the metrics that I look at as far as days on market and inventory, price to sales rate, price to income, home price to income ratios.
That's gone way up.
home prices are going to go down. There's no, nationally speaking, but especially where everybody moved, where all the banks made the loans in 20, 21, 22, 23. So, I expect a lot of pressure in the real estate market, and I think the renters are going to be stopping to pay rent as the home price rolls over. And the calculation is now, this was a prediction of mine several months ago, but now it's coming to fruition. Wall Street is selling, not buying these homes anymore. They're selling and adding to inventory. Inventory is skyrocketing in Texas. It's really ramping up here in Florida, where I have a house. So
are you expecting a ripple effect to the banks then?
I do, absolutely, 100%.
Yeah,
100%.
okay.
Even though the banks have been a lot of that money that was in AI related investments ran into the banking sector. And now we see yields coming down because the market's starting to sniff out trouble. If Trump doesn't get his, so in 2018, Trump passed the Tax Cut and Jobs Act. Mm-hmm. Okay, that went into effect in 2018. That slashed the corporate tax rate dramatically.
Yeah, too.
That rate goes back up in December of this year. The hope is that we can get something passed that would keep tax rates as they are. Now, of course, the Trump administration would also like to cut taxes on, or actually eliminate taxes on tips and Social Security. But that's going to be done through reconciliation. And if that's done through reconciliation, you have to pay for it. And to pay for, especially if you want to get the Republicans in the Congress to vote for it, some of them in Congress, you have to pay for it somewhere. And that means you're going to be raising taxes somewhere else, which are tariffs. So if you look at the sequencing, it's deportations, and this is good. It's putting a wall up on our border. That is good. I think tariffs are wonderful in the long run because it helps to build our manufacturing base. There's no reason why global trade, from the U.S. point of view, should be, hey, you send us your manufactured goods and we'll send you pieces of paper. And then you take those pieces of paper and buy our stuff, our bonds and our stocks and our real estate. And we'll sell our country away to you, our future, with interest, piece by piece. That doesn't really make sense. It's not trade. Trade is, hey, I produce a lot of oil and you make a lot of rare earths and we'll trade. That's trade. So in the long run, these tariffs are necessary, but in the short run, they're very disruptive. And that's why I think GDP is going to come down on a second derivative basis from 4% all the way down to a single handle, 1%. So right now, I'm not predicting a recession imminently. It's going to feel like one. And for a market that's anticipating 14% earnings per share growth, it's just not going to happen. And it's trading at a very rich multiple to that 14%. That's what the problem is right now. Okay.
So I got all that, and I appreciate that answer there. I'm going to move over here to AI. I have a question. It's kind of tied into a lot of what we've been talking about, including unemployment. So Meta has approved a plan to increase executive bonuses about a week ago. That's after cutting 5% of its workforce. So they cut 5% of the workforce like 2 weeks ago or 3 weeks ago. And then a week ago, they say, oh, guess what, guys? We're going to give all the executives higher bonuses. So AI appears to be taking over jobs, where maybe you needed 100 coders before. Now you need 10 to do the work of the 100 because the AI comes in and does the other 90%. This is particularly in tech. So where it enables companies to achieve more with fewer resources is what I'm saying here. This is a trend that is widening the gap between the haves and the have-nots, so the owners, the upper level executives, et cetera, they're the haves. And the commodity workers, the content providers, the tech guys, the coders, et cetera, those are the have-nots because you don't need as many of them. Are we witnessing the early effects of AI on the workforce and growing inequality with the potential for these issues, like what we're seeing at Meta, to worsen as AI improves and becomes more widely adopted?
Well, technology is very disruptive. I mean, when Eli Whitney invented the cotton gin, there was a lot of laborers that were displaced. But the thought is, well, these laborers, instead of picking cotton, can go out and do something else. And eventually that's what happened. But in the short run, especially if the technology is deployed expeditiously, it can be very, very disruptive. And here's my fear, Gary. My fear is that you have this AI deployed, and it really could be very, very important when it comes to productivity. It could really boost productivity greatly, like we've never seen before.
Mm-hmm.
So that's output per hour of work. So that's what productivity is. And you could fire a whole bunch of people. Mm-hmm. My fear is that the government will interfere with this process of creative destruction. We think of Joseph Schumpeter, the famous economist, creative destruction, which is very healthy in the long run. But the government could truncate this and try to preclude it from happening by deploying something like universal basic income. Mm-hmm. Well, instead of telling these people, hey, now that you don't have a job as a coder, you have to go out and reinvent yourself and learn something else and invent new technologies, as always has been the case throughout history. We're going to pay them. We're going to go into debt, have the Fed monetize it, and then send them checks to stay home.
But it seems
it can be extremely destructive where you have that bifurcation where you have the very, very wealthy, and you have people just living off the government trough.
Yeah, and I think this is something that I'm a little worried about as well. It's why I'm asking the question. And it seems that the speed at which AI is moving, in order to reskill, as you're talking about, you lose your job as a coder after going to school for 4 to 6 years and working in the space for however many years, and now you lose your job and you have to reskill. How long will it take to reskill? And in that time, AI is exponentially growing. Mm-hmm. You may not be able to get back into the workforce. But here's another thing. What if you were a business and you had the opportunity to replace people who have attitudes, they have sick day, you have to pay taxes on them, they have retirement associated with them, and a whole bunch of other issues, or you can have some AI or robotics come in and do their job and continue to get more efficient, better and better and better over time for less money. Why wouldn't you deploy that? So to me, it seems like there's no way to prevent the deployment of this as it gets better and better and better.
Yeah, I don't think we should try to prevent it from happening. It's just part of progress. That's what technology does. The only way it becomes a negative feedback loop is if the government interferes, and instead of asking these former coders to retool and re-educate and reinvent themselves, we pay them to stay home, which is what I think is going to happen.
I agree. I do too.
And that, the bleeding heart liberals out there will say, well, listen, these people were displaced. They have no way to feed their family, blah, blah, blah. And this is nothing new in history. People have to re-educate and retrain themselves all of the time. I mean, if you were the best buggy whip maker in the world, guess what? You went out of business. And we didn't pay people to make buggy whips.
Yeah.
So I'm sorry. That's the evolution of mankind. That's the way we become more productive. But you cannot tell people to not reinvent themselves. You have to allow them to do so. Otherwise, you're just going to have a middle class that's non-existent.
Yeah, non-existent.
Cannot. That's another thing. History has proven very clear. Nations cannot survive without a viable middle class. Doesn't work.
It's going to be interesting to see this future. We're talking theoretically here today, but in the future, if it happens so quickly and so aggressively and puts that many people out of work, and with the debt to income ratios that you were talking about earlier, and the likelihood of, a fairly quick default on a mortgage or on a car, and not being, because people are they're so over levered and so close to that, zero baseline. They just don't have a lot of extra. And so if they're put out of work for, 6 months, 2 years, 4 years, while they're trying to, reskill, they literally may end up with nothing. literally nothing. So
Right.
it's going to be an interesting reality when we get there. All right, so Michael, let's shift over to gold here. The global gold market seems to be facing a severe supply constraint, with Swiss gold refineries struggling to secure enough metal. Despite a massive above ground stock, U.S. demand for physical gold, it's surged due to geopolitical uncertainty, trade concerns, and it's exacerbating global supply bottlenecks. The London gold market, it's particularly strained. You've seen this, I'm sure, with large withdrawals from the LBMA and COMEX getting this surge of gold heading over there. Many believe that the broader issue stems from decades of financial manipulation, including leveraged gold promissory notes and off-balance sheet gold leasing by central banks. Here's the thing, though. As confidence in fiat currencies erodes, investors are clearly shifting their capital into tangible assets like gold and agricultural commodities, and this is leading to rising food prices and increasing economic instability. Given this current severe supply constraints in the global gold market and the increasing demand for physical gold, what type of, quote unquote, moment are we potentially approaching here?
Well, up until last week, I would say that there was a very cogent argument to be made why gold should be in a bear market. And the reason was that we had a very strong dollar. There was a lot of glory that was once placed in gold that had been siphoned away by digital gold, Bitcoin. Interest rates were rising on the long end of the yield curve, and nominal rates rising is really not that great for gold. There was no recession in sight. But then you had these two things that were new and unique to the gold market. And so number one was there was going to be an audit of Fort Knox. There's going to be an audit of Fort Knox. And the rumors were I didn't believe them, but Fort Knox was going to open the doors and there'd be nothing there. No gold, like as if they would actually ever do that, Or the gold would be gold-plated tungsten. Okay, maybe. Or maybe more, a less obvious thing would be that the gold was there, but it wasn't ours. It was all loaned out, which is probably a more realistic. So that was like sort of lighting a fire under gold. And then you had this other rumor that Treasury was going to revalue gold from $42 an ounce to somewhere near a market price, which is closer to $3,000 an ounce today. Or it could be, maybe $100,000 an ounce or $140,000 an ounce, which would, pay off our debt. We can pay off our debt. Now, I never really bought into either one of those hysterias because, first of all, the Treasury owns ounces of gold. I think it's 261 million ounces. I'm not sure. I think that number's correct. And I don't care what they say it's worth. I don't care if they say it's worth $0 or $1 million an ounce. It doesn't make a difference to me. The gold, you have gold, supposedly. Let's just assume it's there. And the gold has a market value. Everything else is an internal accounting measure from the Treasury. I don't care if they market to model or market to market. It doesn't matter to me. But here's where it gets a little funky. And this is where I don't understand it. This is what I just don't get. Apparently, if Treasury revalues gold to something more of where a free market would value gold at, instead of $3,000 an ounce, that would somehow enable the Federal Reserve to print $750 billion, which would be the new value of this gold, and hand it to the Treasury and stick it in the Treasury general account. In other words, monetize $750 billion overnight. Which would be highly inflationary because then the Treasury could just take that and pay down debt, which is new money flooding the economy. Now, I don't think that's going to happen. Scott Bessent says it's not going to happen.
Yes, he did.
But maybe it is. I mean, one thing about the Trump administration is sometimes they change their mind. Let's be honest with it. And I love him. I love the guy, but they changed his mind. So that would be a flood of inflation, which would really not only an acknowledgement of gold's new value by the government would be very supportive of gold at $3,000 an ounce. And then the inflation on top of that would be extremely supportive to gold. Do I think it's going to happen? No, but it's out there and it's been very supportive to the gold price. One other thing I have to say about gold is maybe it's just the same old thing with gold, which is the number one driver for gold isn't civil unrest or geopolitical tensions. It isn't even the dollar, Gary. The number one driver for gold is the direction of real interest rates. That is the number one. Back tested. It's proven correct. So when you have inflation heading higher, which is what it's been doing of late, and at the same time you have a central bank in the United States. We're talking about the dollar value of gold, right? So we're talking about the Federal Reserve. The Fed has been cutting interest rates and still has a bias to reduce interest rates. Now, I think that's hysterical. Maybe not hysterical. Maybe more sad.
I know,
especially sad. Maybe. I think it should be derided. He should be derided, and it's very sad, especially for that middle class and lower, which has been pounded by inflation. And now you're saying you have a bias to ease rates. They have an asymmetric, they have a symmetric. The Fed has a 2% inflation target, and you can miss it to the downside, you can miss it to the upside, but it should be symmetrical. Well, Gary, they have missed their inflation target to the north of 2% for almost 4 freaking years.
It's unbelievable.
And even now this is 4 years. We're in 2025. So after inflation was running in the double digits, close to 20% in reality, after you bankrupted the middle class and after you bankrupted retirees and all those underemployed people, millions upon millions, you finally got inflation down closer to 3 and change, even though now it's going the other direction. And now you're talking about maybe cutting rates again. That's your bias to ease. And maybe that's what gold is really, really enjoying most of all. Maybe is the fact that real interest rates. So if gold, if nominal rates are falling and inflation is rising, what happens to the level of real interest rates?
Yeah, that's good insight.
They plunge, and that's what's happening.
Yeah, that's good insight. All right, so Michael, many experts and investors are seeing the gold equities as being extremely currently undervalued, yet with low investor interest, despite these rising gold prices that you mentioned. They see this presenting a contrarian investment opportunity. There's a divergence between the rising gold price and the shrinking amount of GDX shares. But since January 1, gold and gold equities have outperformed the Mag 7 tech stocks as GDX and GDXJ. They're both up about 15% or so on the year. Is this the beginning of a long-term gold equity bull market, or is this just a blip on the radar?
But I have to pick one of those.
Well, tell me whatever.
I think gold is going to be much, much higher over the years. And the reason why I say that is because the United States only has it's an insolvent nation. If you look at our total liabilities, totally unfunded liabilities minus our assets minus total unfunded liabilities, it's negative. So that's not my opinion. That's, you go look at the debt clock and you'll see I'm correct. And then we have the debt of this country, which is 720% of our revenue. I mean, and we're adding 40% of our revenue, the equivalent of 40% of our revenue to that debt every year. So I think the only choice is a default. And I think they're going to continue to default using inflation. They have no choice. And I believe that pace of default through, we'll call it an implicit default, is going to accelerate over the years in a huge fashion. And that means that the price of gold in dollar terms is going much, much higher.
Now,
I don't know if this is the start. I can tell you this. Let me expound on that just for one more second, one more minute. in the next recession, and we will have the business cycle has not been repealed, even though we love Donald Trump, or I believe he's again infinitely better than Kamala Harris would have been. I'm a libertarian, so just laying it out there. You had me on your show. I'm going to talk my heart, which is what I know, only way I know how to do it. I believe in freedom and less government, so hence I would be more attracted to Donald Trump than an egalitarian socialist, which is what she's avowed. I mean, not to get too much into the weeds, but she actually said she wants to provide. Kamala Harris once said that we need to provide equal outcomes, not a level playing field, equal outcomes, which is a form of egalitarian socialism. So I said I think gold is going much higher. I think the debt has to be monetized, and unfortunately, that's going to be the case.
Okay. All right. Well, hey, everyone, welcome to this fantastic interview with Michael Pento, founder of Pento Portfolio Strategies. This has been an amazing discussion. And before we wrap up here with our final set of questions for Michael, I just want to direct everyone over who are interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content that offers expert-driven insights on global trends, asset sentiment, and economic geopolitics, alongside deep dives into the mining sector. Even without premium, there's plenty of free content daily, so visit metalsandminers.substack.com. Join us and explore. Thanks again for watching. Now, I'm positive that you've enjoyed the conversation with Michael as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, Michael, once peace agreements are finalized, like that's a topic that President Trump has emphasized before he was even elected, the reconstruction efforts in Ukraine and Gaza will need to begin. Do you anticipate that this rebuilding process will significantly increase demand for construction materials and base, commodities and such, and potentially kickstart the next commodity cycle?
It should, and I'll just have one caveat in there. It will not be able to supersede a recession. In other words, if we have a recession that occurs at the same time, a global recession, and the global economy is very much intertwined now. So if we have another global recession and China and Japan, Europe and America go offline, there won't be enough money available to even start these projects, unfortunately. So beside that occurrence from happening, then I believe, yes, you're correct. We have a tremendous amount of reconstruction in Gaza and in Ukraine. God willing, there'll be peace in both those places in our economy.
Yeah, I agree.
Economy. And people can go about living their lives peacefully, and that should be very beneficial to base metals and energy. Okay. Again, it cannot and will not override a global recession, and that's my fear. I don't know. Like I said, I don't think it's going to happen tomorrow. My model says there's nothing to worry about significantly in the next few weeks, but it could be later on this year as the liquidity continues to get drained from the system. Again, the reverse repo facility, Treasury General account,
especially with the 10 trillion-ish debt wall that's coming due. Also,
the rolling over of all this debt. Bank lending has started to. Percentage of banks that have been tightening lending standards had been going down. Now it's going back a little blip higher again. The value of real estate, it's all tied together.
Yeah.
So you model that all together, and we could be in big trouble later this year. But and I'll leave you with this. Right now, I am, as I manage portfolio for clients, we are not short the market. But the upside is very limited. So we have hedges in place And we're in those sectors that have been neglected over the past several years.
Understood. All right. Well, let's finish off our discussion here with what I call a lightning round. I'm going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100, being an extreme buy is 100 and 1 is an extreme sell. This is not financial advice. I'm just getting your perspective on it. If it's an asset,
this is my response for what I would do with my own portfolio. Just
sure, fine. So 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Then just give one sentence as to why you take that position. Okay. All right. So on a scale of 1 to 100, right now, is gold a buy or a sell, and why?
Gold is a buy. I would give it a 70 because real interest rates are falling.
Okay.
And debt monetization will continue, and that process will become exacerbated over time.
Okay. Gold miners, 1 to 100, are they a buy or a sell, and why?
That they are a 45. They're a hold. You didn't say 50 would be a hold in your scenario. I would be a hold, say 50, 45, 50 area, because gold miners are stocks and gold is money.
Okay.
The volatility profiles for both are extremely different. And if I expect trouble in the stock market, I sure as heck, I mean, maybe it won't be as bad for gold miners, but it'll still be bad.
All right. Silver, 1 to 100.
Silver is, I would say the same thing about silver as I would about the miners. Consolidate and repeat.
Okay. Silver miners.
Much higher volatility profile than even gold miners. You can't get any higher. You're almost talking in Bitcoin range of beta. In this kind of environment, I would say it's a no touch for me. So,
you're saying the silver miners?
Silver miners, no touch.
So what's that, a 1 or a 20 or?
I have to put a number on it, huh? Oh, this is
yeah,
fun. Okay, put a number on it. I would say 30, 25, 30.
All right. Copper, 1 to 100, and why?
Copper would be 45. There's a lot of demand for the rebuilding of the Gaza Strip there, and also for Ukraine. But global growth is slowing, and that's not really a great time to own copper.
Okay.
So
Uranium.
I separate commodities into two buckets. One would be base metals and energy and agriculture.
Understood.
And then money. So two different things.
Understood.
And the same thing goes for uranium too. You could throw uranium in the same bucket too. So uranium
as copper?
Yes.
Okay. What about oil?
Geez, that would be. I'm gonna give that a 60. So it's a buy for me, even though I just kind of going against everything I just said in the past in the other questions, just because they're so cheap. I mean, they're so well. These companies are so well run, and since we're not imminently going into a recession, I think it's worth holding them.
All right.
I'm not going to be leveraged long, but I think you should have some energy in your portfolio.
Okay. The NASDAQ.
That, my friend, is a sell, and I'm going to give that a 20.
Okay, and why?
Why? Because when you, like we talked about, having everybody in that QQQ and the NASDAQ, top 100 and the NASDAQ in general, that's where everybody's been hiding. And that's where most of the carnage is. You know, we've never had anything like this before. Even in the Nifty 50, looking at the 2000s, where these target date funds and these buy and hold indexes, they just automatically, you know, you have your paycheck has a certain amount taken it out of it, and it goes right into the major averages.
Yeah.
And the major averages are cap weighted, and the cap weighted, it keeps feeding more and more money into those NASDAQ stocks. Those NASDAQ tech stocks are overweighted, and the trap door could be opening up very shortly if it hasn't already been open.
And it's not just money flowing from workers in the United States; it's coming from all over the world.
Correct.
So, all right, the S&P 500.
That I'm going to give a 65 to, and I'm going to just be a little more specific and say the equal weight S&P 500 is something I would own rather than the SPY. I'll go ETF on you. Rather than the SPY, I would own the RSP.
Okay, and why are you giving it a 65?
It's an equal weight index, so you're going to have a lot more of those other companies in there that haven't enjoyed this great concentration of funds. And since we're not in a recession and the liquidity is still mildly in the positive bucket, then I would say, hold some of that in your portfolio.
Okay.
RSP, not SPY.
All right. And finally, on a scale of 1 to 10, with each representing a percentage, like 1%, 2%, where do you see inflation ending the year?
Well, can I just, before I answer that, you didn't ask me about bonds. I'm surprised.
I did not ask you about, do you want to share about bonds?
I do.
Please.
I do. I would be heavily, when the yield curve is essentially flat as a pancake, T-bills and the 30-year have almost the same yield. It's just a few basis points to separate the two. I would overweight the short end of the yield curve. I think the big surprise, if I'm correct, and we do have a hiccup in the economy and a recession, you're going to see the Fed lower interest rates very, very quickly. So I would have a lot of short-term treasuries in your portfolio. I would say is an 80.
Okay, I appreciate you.
Strong buy. Sorry.
No, I appreciate you sharing that.
Okay.
All right, and like I was saying, lastly, on a scale of 1 to 10, with each number representing a percentage, like 1, 1.5, 2, 2.5, 3, where do you see inflation ending the year?
Ending the year. Oh boy, this is the hardest interview I've ever done. And so when you give a value to inflation going out, 9 months from now, 10 months from now, it's very hard. It's very hard to do.
Well, you can give me a range.
Here, let me answer the question this way. I think inflation. Well, I know inflation on a second derivative basis had been increasing slowly. I expect it to fall because the owner's equivalent. You're talking about CPI. We're talking about CPI here, right? Or we're talking about the PCE. The way the Fed measures is core PCE. In fact, the Fed doesn't know what the hell they're doing. The Fed measures it first with the CPI headline, then it's core, then it's PCE, then it's super core. Whatever metric looks good at the moment, the metric du jour is what they'll focus on. I think inflation could be coming down because if you look at owner's equivalent rent, that is a major component to CPI. It's about 40% in the index there, and that's falling. So yeah. I think inflation will fall.
So we're currently at 3.1, 3.2?
Yeah. So I think it could go into the low twos, not imminently, but as we enter into close to a recession, could go even lower than that if we hit a recession. And then the most important question you should ask me, in my humble opinion, is you model I have something called the inflation deflation economic cycle model, which looks at the second derivative of inflation in the context of growth. Inflation on a second derivative basis could be falling as opposed to rising where it is now later this year. So right now I'm more hedged towards inflation, and I'll point to that energy component that I still hold and still long equities in a 20% net long. And then it falls later this year. And the most important thing is after we have this recession, and I forgot to mention this on another question. I'm glad this came back to me. Thank God. I think deficits could go to $6 trillion if you look at history and what happens to our deficits in a recession. The recessions of late, post 2000, where the income to the Treasury collapses and these automatic stabilizers kick in. You're talking about $6 trillion deficit. That has to be monetized with another round of helicopter money. And Gary, do you think inflation is going to stop at 9? or 10, the way they calculated it the first time? I don't think so. Everybody's going to know the
Yeah.
game's out of the bag. I mean, you've now inculcated to investors that we have no ability to control asset bubbles without destroying the economy. So maybe Fed comes out with a new paradigm where they say our new inflation target is nothing less than 4% instead of 2.
That's a major problem.
Which means you'll be at 8% or higher. But anyway, the point of the matter is, I think inflation is going to be like a yo-yo this year. So it's second derivative increase early part, then it starts to fall, and then it's the response from the Treasury and Fed due to the falling economic parameters and falling asset prices and distressed bank assets that I see coming. It's like I'm not telling you it's going to happen tomorrow. We still have that grand reconciliation of asset prices that must occur, which will damage banks' balance sheets. And that is why the Fed exists. They exist to make sure banks are solvent. That's why they were created, not to protect the middle class. That straw man it's a red herring. It just doesn't exist. It's to protect banks. They're going to come around with another round of massive debt and deficits that will be monetized by the Fed. And I think inflation will run intractable stagflation. That's coming.
Well, when that starts to happen, we are going to definitely have you back on, and we're going to be chatting about that. This has been an incredible conversation. Michael, thank you for coming on to Metals and Miners. Would you please share with everybody where they could learn more about your work and how they can connect with you?
So the website is pentoport.com, and on it you'll see a button for the midweek reality check, which I publish every Wednesday. It's a 5-week free trial, and if you like what you hear, it's $50 a year. And in that podcast, I give you the real data that you need to focus on and my interpretation thereof. And if you have $100,000 to invest and you qualify for the portfolio, because I am a fiduciary, so you have to qualify for the portfolio because this is an alternative portfolio. It's a long, short strategy, which in some cases that's considered an alternative strategy, a more risky strategy. I think it's absolutely the most intelligent thing you can have, for your viable retirement, is to have a strategy where you can not only sell stocks and raise cash, but you can actually benefit from the reconciliation of asset prices. So if you have $100,000 to invest and you qualify for the portfolio, I will manage your money personally in the inflation, deflation, and economic cycle paradigm portfolio.
Okay. And you're also on X, right?
I don't use it that much. I'm not.
No.
Listen, thank God I'm not on. I don't have to battle people on social media and tell me what an idiot I am. You know what I spend my life doing? I concentrate on doing the best thing for my family. That's my goal.
Well, that's good.
Right? So I don't have time to argue with people or try to convince people why I'm right and they're wrong.
Yeah.
You do you. I'll do me. I'm not on X. No.
Okay.
I think I have one of my assistants publishes things on LinkedIn and Twitter, but who cares? You get my podcast. I manage your money. You're good.
Okay. Well, I'm going to have the information for your website up on the screen. Folks, if you're not paying attention to what Michael Pento has to share, you need to connect with him. You need to learn about what he's sharing. Get in there and check out that podcast that he mentioned and see if that's right for you. Michael, we really appreciate you coming back on to Metals and Miners. I look forward to having you back on sometime soon. Everybody else, thanks for watching.
Thank you, Gary.
Hey everyone, welcome to this fantastic interview with Michael Pento, founder of Pento Portfolio Strategies. This has been an amazing discussion. And before we wrap up here with our final set of questions for Michael, I just want to direct everyone over who are interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content that offers expert-driven insights on global trends, asset sentiment, and economic geopolitics, alongside deep dives into the mining sector. Even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com. Join us and explore. Thanks again for watching.